Recession's cancelled, new all-time highs are well and truly on their way, and of course the Melbourne Cup for the Aussies. Now I've got a little more info for the Aussies coming up, especially as we've got our meetup coming up this weekend. But for everyone else, let's just dive straight into the content as, of course, I've got a lot of data to get through, especially for Bitcoin and the SP 500, as we are seeing very significant signals in those markets, which essentially mean all-time highs. Guys, hit that like and subscribe button. It's the best use of your time in these moments right now. And of course, it helps out the channel. We are the home of macro cycle analysis. Let's just crack on with it, and I'll give you some of the updates later on. Now, I just posted this morning. We're looking at the retail starting to come into the market. The main thing that I've noticed here, and I can share some more data with you in the future, is that YouTube subscribers and views have definitely ticked up over the last 1 to 2 weeks based on what I think is the breakout of Bitcoin from $32,000. So a little correction there, 35 is the current price, 32 was the breakout. If this is correct, then I suspect over the next 3 to 6 months, we will see the dormant YouTube channels start up again. And that is going to be another signal, like, you know, I like my market sentiment signals, that we are coming closer to that retail mania, that bull market mania. So those channels, maybe you know them, maybe you don't. There was stuff around in 2020, 2021, and basically they went quiet in 2022 when the bear market hit. Basically the huge channel stuff over the 500, 600, 700,000 subscribers, they were going, making a lot of content, and then they stopped. That is a good signal, at least for me, to identify that the retail mania is coming back, because essentially they're just interested in making content when the viewers are here, because they base their business around that. So that is just a signal for me. It's no dig at anyone. I'm just using that as a market sentiment signal, and I'm sharing it with you guys. If you notice something similar, definitely let us know in the comments section down below as well. So that takes us across to BTC, and I want to do an update of the Wall Street cheat sheet right now. So we've been covering each of the market sentiments along the cycle here. We've got euphoria, complacency, and then the dump to all of the negative emotions: anxiety, denial, panic, capitulation, anger, and then in depression. So it seems like we are now out of that, and we're looking at this for Bitcoin. As I posted this week, we've also done this on the Wyckoff schematic for altcoins. So I'll update that in future videos, so stick around for that. It looks like we're heading into disbelief as we break out of those zones. So if you can cast your eyes to the template in the background here, you can see the tops and then more of the tops here, and they sort of line up, and then you get that nice breakout into disbelief. So I think those tops were potentially around these levels. It seemed like disbelief going back to March as the market broke out of 25,000 and then hung around these levels for about 7 months. So after that 7 months, we then got the breakout of 32,000. So we could be leading into hope, but it doesn't matter either way. Hope, disbelief, we're still in a bull market. That's the main thing here. What we will see at the end are all of these other emotions. So we'll keep up to date with that and just continue to follow it. The main thing you don't want to get wrong is where we are in the timing of these emotions. The masses, which is why I brought this up at the beginning, the masses will come in at these emotions here. Sorry about the overlap here. Euphoria, optimism, etc., etc. They will think they're at the beginning of the move. They'll think it's a disbelief. They'll think it is part of hope. But because you've been around the markets, or at least I hope you have been, for over 12 months now, seeing those lows come in, seeing the panic and the capitulation, and you'll know that the disbelief happened earlier, probably 12 months earlier, when by the time we get to these peaks later on. And if you potentially got these emotions wrong, then just adjust your charts. There's still time in the market to get these things a little more accurate as the market moves on. Of course, that's the way I'm seeing it. There's obviously going to be disagreements here, but so far so good. Everything has been on track according to what I've seen when it comes to the Wall Street cheat sheet, going through that depression and the anger and then coming out of it. There was a little bit of discrepancy over the last several months, people thinking that we still had further depression to go, but maybe you're starting to see that that's not the case. So just adjust things. There's no problem in the markets if we are wrong. It's just learnings, and then we have to make those corrections. Now, the real estate cycle is still in full swing. However, we will get to a point that we get the mega collapse. And at that time, we'll probably see the collapse for a lot longer than many are anticipating. The collapse we had in 2020 really was very, very short-lived. Yes, the government's printed a ton of money and that's screwed up the economy. And now we're seeing a lot of volatility with big moves to the upside and big swings to the downside. So eventually we get to a point that is just unsustainable and we get the collapse. Why didn't it already happen? I'll leave that up to the economists to figure out. But what we follow is the cycle. And so far the cycle is still on track. I'm bringing this up again because I want to look at some recession data. Basically, the old recession is cancelled calls, especially for 2023, because we have never seen in history a recession in the third year of a presidential cycle. It's basically the pre-election year. Is that always going to be the case? Probably not. So that's why I just want to remind ourselves about the 18.6-year cycle. The symptom of the mega collapse coming is the big mania, the boom, and we're starting to see these prices rise. We're seeing it in Bitcoin and the S&P, and I want to show you that data in a moment as well. Now, a quick one just for the Aussies. Interest rate announcements coming out today. It's Melbourne Cup day, biggest horse race in the Southern Hemisphere. We're looking at a potential interest rate rise here to 4.35%. Do you think that's going to happen? Are we going to see it, or are we going to stay flat at 4.1? Either way, property prices have been rising. Now, this is back to everyone. That was a quick one for the Aussies. Property prices have been rising around the world. And yes, I do hear some people say, well, not in my area. Okay, we're looking at things globally and nationally, across the US, across Australia. This time, Australia is up again, and we've already covered it for the US, guys. Property prices have been also climbing up with a bit of a pause the last couple of months, mind you. But in terms of Australia, this thing continues to power on. We are seeing 1% a month here. And for some of our major cities, Sydney, Perth, Brisbane, 10% for the first 10 months of the year. That's pretty wild. Normally people expect property prices to go up 5%. Now we're seeing them at 10%. We talked about this with our members back in February and March as well. So you can see this date here was March, using the analysis that we use here on the channel for the charts. So putting our own charts together for the real estate cycle. So if you want more information about this, do subscribe to the email list. Link is in the top of the video description here. And we share that information with our members as well. So you can get a better understanding of how this works. This was the time. Back in March, we said the safest place to buy the higher swing low. Remember what March was? March was the banking crisis, the thing that everyone thought was going to collapse real estate. It didn't, and property prices have been up around the world since that point. This is the stuff that we go through in great detail. So if you want more information about it, if you're looking to buy yourself properties and understand how that cycle is moving for the biggest investment that most people make in their entire lifetimes, you know where to go. TIA Crypto. So moving on from that, looking at the recession data now. Number of recessions starting in the year of the presidential cycle. Year 1, year 2, and 3. We are in year 3 now. So this is 2023. Next year is 2024. Recession, it didn't happen this year. Cancelled, over, not going to happen. Quarter 4, it doesn't seem like it at all. And seems like everything is on the way up from this point. The other thing to note is the majority of the recessions happen in year 1 and year 4 of that cycle. So let's continue to log in the data here. That's 2025. Then you got 2026, 2027, 2028, 2029, and then over into 2030. So the last couple of these, 3031, 3032. Now I brought up the 18.6-year cycle to see how this all fits in, because I think at some point this will have to get a 1 into it. I don't think we can go throughout history, even though this is a pretty good record here, of having no recessions in the third year of the presidential cycle. So leading up to 2027, there is that possibility that finally there gets a 1 put in this zone, or potentially the recession gets pushed out into 2028. So keep that in mind. Maybe it comes in 2024. But the markets are still trending up at that point based on our real estate cycle. So make sure you are trading the markets and the charts and not the word recession. I put a post out about that on Twitter as well. That is going to cost people a lot of money just waiting on this call of recession. Just trade the charts and forget about the noise and who's calling recession or not recession. And remember what they've been doing for the last 3 years, every single year trying to call a recession, and they've missed out on huge gains from those March 2020 lows and then the October 2022 lows, and then the March 2023 lows, and probably the October 2023 lows as well. It's a big game to be calling recessions. Those channels, media outlets, newsletter subscriptions make the most money because they're always calling for doom. Now, I have even more data for you guys as well. There's some breadth thrust info coming up, but essentially if the interest rate hikes are done in the US, then that doesn't mean that it's a bad thing and the cycle, the markets will collapse from that point. We have some information, some data here looking at hikes finishing and then what's happened in the following 12 months. So like I said, this isn't going to go on forever. We're never going to see a boom forever, but at the peaks, it will definitely seem like that. But that's probably the point where it's time to get a little bit nervous and start to rein in a little bit of that capital. So 12 months after they stop tightening, then we've seen positive results. There's an average of 14.3% 12 months later. So it doesn't mean it's the exact end, but maybe there's still some more time to go and make some pretty good gains. That has happened 80% of the time. Markets have gone up. The two times that it didn't go up, 1981 and 2000. .com crash, and then 1980s was the recession in the US. A lot of problems over there. Got a bottom into 1982. Markets pumped into 1987, and the real estate market also pumped into 1989, 1990 before the recessions happened from that point. So it doesn't mean it's a bad thing if the interest rates stop. Just keep that in mind because you will hear about that a lot. Now for one of the rarest, most bullish signals for the stock markets, the Zweig, tell me if I'm getting that right or wrong, Zweig breadth thrust, or the ZBT. So when this comes up, at least what it's shown since the Second World War, 100% of the time, I hate saying that, but I mean, that's the data. 100% of the time, in the next 6 to 12 months, markets have been positive with an average return of 15% in 6 months to 23% 12 months later. So if we were to see those sorts of gains for the SP 500, 15% in 6 months taking us to May, 15% takes the market to 5,000 points, which puts it at a new all-time high. So going back to the titles of the video, looking at new all-time highs for Bitcoin, the S&P, and real estate, this is one of those reasons for that new all-time high, along with plenty of others that we've covered here on the channel. So make sure you hit the like and subscribe button. Our free newsletter is coming out in about 24 hours time. So link in the top of the video description gives you more info about cryptos, Bitcoin, stock markets, real estate, everything in between there. 15% takes us to 5,000, 23% in 12 months time. So to November is going to take us to about 5,400 points. That's, again, another all-time high price for the S&P. Sounds ridiculous considering the backdrop of what's going on around the world. I'm just reading you the data. Now, there's a lot more to go through with the thrust signals, so I'm going to leave that for future videos because we've got a lot to get through. Let's take a look at the S&P 500 and the all-time highs along with BTC. So the data I've got here is looking at the regions of the S&P where basically it's been trading sideways. So in case the S&P 500 continues to trade in this range for the next several months, typically these sideways periods are great accumulation periods for the market to then break higher. Now, that needs to be on the back of higher highs and higher lows. You can see some significant higher lows forming. Here is your pandemic, but we've got higher highs also forming on the monthly chart here as well. Take it back to the next one. You had a breakdown here of some of the monthly bottoms through this period where the market was running into the peak, but the significant monthly lows continued to hold in. It did have a slight break, but look at the close. The closes all came back above the previous price ranges as well. And there you get your higher highs, higher lows continue to form on the macro chart here as well. The periods that I have circled here are the time frames where basically the price got stuck in a trading range. So essentially that was roughly around 29 months, call it 2.5 years. What does this look like on the Bitcoin chart? Well, it almost coincides pretty well with the Bitcoin bear market and the accumulation period to the beginning of the breakout. So I want to get a time frame here and a pattern of what the S&P is doing. to then see if we can forecast what happens to BTC. Now, of course, some of these reasons might be, well, more money starts to flow back into the system. That pushes the stock prices higher. Sure, that can be one of the reasons. We just want to focus on what the chart is doing. And if you want to go and try and pick any of these other reasons, I'll leave that to you in your own time. But I just want to focus on the charts and how the market is trading that information, because essentially the facts are in the charts and not somewhere trying to dig up why did this happen. Those reasons will come out in the future. Let's call it that it was more money printing. So we can move forward into 2018, 19, 20. The peak for Bitcoin was, of course, December 2017. A month later, the SP 500 peaked, and then it was basically in a volatile trading range. Now, I don't have the full-on lows here and the peaks, because we had a lot of volatility in that period based on the money printing and, of course, a worldwide pandemic, which we hadn't seen in over 100 years. So in terms of this range here, roughly about 30 bars again before the market started to break out. And you can see here on July 2020, it had its highest close out of this entire period, which essentially was pushing towards new all-time highs again. You had the pullback, so a new all-time high, then a pullback on top of the range, and then the market took off from that point. You had roughly 12 or so months for Bitcoin into that new all-time high, a little longer for the S&P 500. And again, the same sort of thing, rinsed and repeats, bear market for Bitcoin. And in this case, the stock market also had a bigger pullback through 2022. So where does 30 months take us from the peak, or those periods there, roughly around the peak of the Bitcoin top? 30 months takes us out. So we've just measured this, 29 months, 30 months. Let's do it again from the peaks. 30 months takes us out to roughly May 2024. If we want to move it to the exact peak, which was January of 2022, then that's going to take us out to July of 2024. So that's why I'm still looking at roughly Q2 to Q3. These timeframes give us an idea, but we just got to follow the charts to give us a more accurate answer. The timeframes are going to help us so that we don't get stuck on the wrong side of the market like the macro bears have been, expecting lower and lower prices. We just keep watching how the patterns rhyme rather than repeat exactly. So this, I think, is a fantastic case of how the patterns are rhyming, but they don't have to repeat exactly. So it's important not to throw the baby out with the bathwater. I think that analogy works well here. So if we're using the time frame from the peak of the S&P 500 and we move it across to the July timeframe, well, it's about 8 months. If we take it to the May timeframe, it's about 6 months. So what we've covered so far is the likelihood, not the guarantee, that the S&P 500 is going to push to new all-time highs within the next 6 to 12 months, breaking the 4,800 point level, hitting 5,000, maybe up to 5,400 points by the end of 2024. And typically when that happens, like we've covered on the channel before, S&P breaks into new all-time highs, then Bitcoin is a short while behind that as well. But that's the first signal that it looks like investors are getting more risk on again, and they want to start to throw some more of that money around the markets. And of course, Bitcoin is typically one of those recipients, as we've seen over the last 12, 13, 14 years of data. We didn't just come up with these roadmaps by chance. This is the data that we've been following for months and months on the channel. Obviously, while many are talking about the markets collapsing, the data has said otherwise. We're looking for significant lows in the market to form and then follow on for those moves to the upside. This is one of those roadmaps that we've been watching, basically the seasonality of 2023. And we've seen after big years to the upside, S&P, when it does 10% or more by the end of June, well, we get a bit of a pullback because obviously it's a correction, and then the market tends to move on again. Now, we're going to get this massive move on and take out the highs. Let's wait and see. But essentially, we've got 2 months left in the year, and we've already started to push out and getting very close to those previous October highs. Now, before I go on with this, I just wanted to give a quick shout for the Aussies. If you're coming to Melbourne, or you live in Melbourne this weekend, you want to come along to the Australian Crypto Convention, tickets are here. Link is in the top of the video description. Subscribe to the email list, and we'll send out an email for those free tickets as well. So that's coming up end of this week. All right, guys, so back to the S&P 500. You can see we had one of the most monster days, or monster weeks, sorry, that the year has seen, going all the way back to the cycle lows and November of 2022, so over a year ago, they were the biggest weeks. So we've seen the seasonal move to the upside that the roadmap has anticipated. These are the levels to overcome now, the previous tops of July and September. So those price points, we're waiting for a 4,600, a 45 and a bit, and then of course the most recent one here in October around that 4,400 point level. Like and subscribe, videos popping up on your left-hand side. I hope you found a ton of value from today's video, and I've covered a lot going on. So stick around for future videos. The markets are getting hot. We are seeing subscriber growth go up. We're seeing views, more and more views come in. And typically with that more subscriber growth means there's a few more retail coming to the markets. Don't feel bad if you're one of those as well. This is just part of the game. We try to let everyone know as best we can at the lows, but unfortunately, that's just the way of the market. It's the way of the cycles. If you want to avoid it, stick around through an entire market cycle and avoid being part of the retail crowd that come in way too late. Thanks again, guys. See you at the next one, or I'll see you at the weekend. Peace out.